Okay, have it. And this is a few-minute segment?
This will be around 5.
Okay. Okay, whenever you're ready.
I want to spend a couple minutes and share with you a situation that I had recently in my office. I had met with someone that might not be unlike a lot of our viewers right now. It was someone that had recently retired. They were in their early 60s, and they wanted to make sure that they had their retirement assets in the appropriate places so that they could have guaranteed income to last them the rest of their lives. Now, this particular individual had about $800,000 in retirement assets. That was broken down to $600,000 was invested in bonds and $200,000 was invested in stocks. Now, rather than using individual bonds and individual stocks, they were relying on mutual funds, and that was the breakdown that they had. Now, those that watch us here on the show know that we talk about the rule of 100 all the time. And this particular individual was mistaken. They thought that they were adhering to the rule of 100. And again, briefly, the rule of 100 says whatever your age is, that's the percentage of your retirement assets that should be safe and protected from losses. And then the difference between your age and the number 100 is the maximum percentage of your retirement assets that you should have at risk only if you're comfortable with risk. So this particular individual really thought that they had as much as 75% of their money safe because that's the percentage that they had invested in bond funds, which in reality, bond funds certainly are not safe and do not meet that definition. We'll agree that they're safer than individual stocks and individual stock funds, but certainly bond funds have risks, they have lost value in the past, and they can certainly lose value again in the future. Now, this particular individual on their retirement portfolio was earning approximately $30,000 per year of income, which was making things a little bit tight. They were trying to see if there was any way that they could maybe increase their income. Now, that's what they were getting from their retirement assets. Obviously, they had a little bit of Social Security to add on top of that. And when we analyzed their portfolio, we found that they were paying almost $16,000 per year in fees. It was right at about 2% on their $800,000. So they were losing a significant sum of money each and every year. And they really felt like there wasn't much more that could be done differently or anything else that could be done better. So what we did is we analyzed the portfolio and we came back and made a few recommendations for them. There was actually a few things that we could come back that would increase the amount of income that they were generating, reduce the amount that they were having to pay in fees, and actually reduce the overall level of risk that they had. So what we recommended was that they take the $600,000 that they had invested in bond funds and roll that over to an index annuity that we work with from time to time. So they invested $600,000 into the index annuity, and then we took the $200,000 that was in their stock mutual funds, and we invested that into a managed money portfolio with third-party money managers. This was actually able then we were able to increase their income for this particular individual from $30,000 per year up to about $45,000 per year, so about 50% more of income. More importantly, we moved them into adhering with the rule of 100. So after we had processed the rollovers for them, they had about 75% of their money safe, which was actually a little more than what we recommend, but this particular individual wanted to be very, very conservative. And we basically cut their fee structure in half. They went from paying a little more than $16,000 per year to actually paying a little bit less than $8,000 per year. And that's one of the big reasons why they were actually able to increase their income. The other thing that we were able to do for them is the income they were generating will now be guaranteed for the rest of their lives. So for as long as they live, that income will never go down. It might go up over time depending on the underlying performance of their investments, but they don't ever have to worry about it being dropped or reduced at any point in the future. So the income's now guaranteed for life. We were able to increase it. One of the reasons why we were able to do that is because we reduced their overall fee structure, and at the end of the day, they were in a much safer position. So a lot of times we'll get questions from individuals, well, Matt, how does your firm help, or what is it that you can do for me, or sometimes individuals will think, well, I've already done my retirement planning. You know, I've just got to ride it out. I'm kind of stuck with it. There's nothing that can be done to improve upon it. A lot of times when we analyze situations, we'll find that there are little things that can be changed or tweaked. Sometimes we've got to make large rollovers or changes, but the vast majority of the time we can share with individuals ways that they can reduce their overall fee structure, maybe reduce the amount of risk that they're taking, and hopefully at the end of the day, increase the amount of income that they're generating. So if you have questions about this particular case or any questions in general about your specific planning that you might be doing right now, don't hesitate to give us a call there at the office and or visit our website. did that. Okay. Let's talk about a situation that we saw recently in the office. I met with someone that had money invested in a variable annuity, and they weren't very happy with it. They'd actually owned this variable annuity for a little more than 10 years, and they had very little growth. Over that entire 10-year period, it was worth just a little bit more than what they had originally invested. And they started 10 years ago with about $500,000 in it, and today it's worth just a few thousand more. Now, those that follow us here on the show know that we're not really big fans of variable annuities, and a lot of times the performance is similar to this particular example because the fees and expenses can be absolutely outrageous on them. It's not uncommon for us to see individuals when they have a variable annuity paying fees of 2.5%, 3.5% per year, 4%, 5%, or in some cases even more. And that can add up to be tens of thousands of dollars on an annual basis. Over a 10-year time period, you could lose tens of thousands, if not hundreds of thousands of dollars on one of these types of accounts. So we're not big fans of them, but this particular individual didn't know what to do. They didn't know if they should keep it or if there's anything that they could do better. Now, they were in a fortunate situation because they had pension income and Social Security. All of their debts were paid. They didn't owe anybody anything, and they really didn't need this money. But one of the things that they were very concerned about was long-term care. If either themselves or one of their spouses had to go into a long-term care facility or more likely have to pay to have someone come into their home, they didn't really know how to pay for that. In this particular couple, they were completely uninsurable. They had some medical issues, and they couldn't purchase a long-term care insurance plan. When we ran the analysis on their variable annuity, it didn't have any long-term care benefits, and their total fee structure when we added everything together was over $24,000 per year, which again is a big reason why the account wasn't performing very well. That means that as they've owned the account for this 10-year period, they've paid over $200,000 in fees over that time period when you add it all together. So what we did is we took a look at it and said, well, maybe there's something that could be done better. There are certain types of annuities or investment contracts today that will have some long-term care benefits or long-term care riders. So what we did is we recommended to them that they roll their variable annuity over to one of these index annuities and purchase the long-term care rider. Now, when they rolled their funds over, they're approximately $500,000 that they had initially, rolled over into the new account, and they were given an upfront bonus of about 8%. So they went from approximately $500,000 in value up to $540,000 in value day one when they did the rollover. Now, obviously, the new index annuity will subject them to a new surrender charge. It'll be several years before they could take all of the money out of the account. However, what they were able to do was dramatically reduce their fees, got them into a situation where they were paying a little less than 1%, so saving them tens of thousands of dollars per year in fees, and they picked up long-term care benefits because this particular account, if either the individual and or their spouse were to need to go into a long-term care facility or again need to pay to have someone come into the home to help them, then their long-term care benefits would basically pay them over $60,000 per year for as long as the care is needed. Now, if they ended up not needing the long-term care benefits, then when they pass away, 100% of the proceeds in the account would pass on to their heirs and beneficiaries. So it's not like a traditional long-term care insurance policy where you pay on it for several years, and if you don't ever need it, then the insurance company just keeps the money. This particular plan allows for you to have what's called a living benefit via the income or via the long-term care rider to use if you need to go into a facility or have someone come into your home. But again, if it ends up that you don't need that care, you don't really lose out on anything because 100% will pass to heirs and beneficiaries. So sometimes when we see individuals, when they have variable annuities, we'll just tell them, you know, there might be some costs to get out of them, and they're going to have to pay a surrender charge or something of that nature. Sometimes if you have a high fee, expensive variable annuity, unfortunately there's just nothing that we can recommend to do better. But in a lot of situations, just like the one that I covered with you here today, there are other options that can be a little bit better for you where we reduce the fees, maybe pick up some additional benefits that you didn't even know were available. Now, if you have any questions about this particular case or you have a variable annuity and you would like us to review it for you, don't hesitate to call the office and or visit our website. For this week's case, I want to talk a little bit about pension plans. A question that we get quite often in the office when someone retires is they will ask us the question, should they keep their pension plan through their employer and just take the monthly income that they're giving them, or would they be better off taking the lump sum and rolling it into some other type of investment account or some
Let's just start again.
Yeah. Getting irritated.
Are you ready?
Punch yourself in
I
the
know,
face.
man. I don't. You said that you needed more bloopers. I'm giving them to you.
me.
Jeez. Okay.
Good?
Yeah. For today's case, I want to talk about a question that we get quite often in the office. When individuals retire, if you have an employer that offers you a pension plan, a lot of times individuals are unsure, should they take the lump sum and roll the money someplace else and maybe generate an income from a different type of investment vehicle, or should they just take the monthly income that the pension plan is offering to them through their employer? And a lot of times you have a lot of different choices. You know, you have payouts for your life, payouts for you and your spouse's life, maybe payouts for a certain number of years. It can get pretty confusing. And our answer to that question a lot of times depends on if you can do any better by rolling the money someplace else and getting yourself a higher income. And sometimes the answer is yes, and then other times the answer is no. So there's no clear-cut response to this particular question. You have to take a look at the specifics, and sometimes you're better off rolling the money, which if you were to do that, you can roll the funds over from your pension plan into an IRA. There's no taxes or anything that are due when you do that. That's a misconception. Sometimes individuals think they're going to have to pay taxes on the entire lump sum amount. So fortunately, you don't have to do that. You can just roll it over. And then you only pay taxes on whatever income that you withdraw. Sometimes that's the best thing to do. Other times it's better to just keep the pension money with your employer and start to generate the monthly income. One particular case that came into our office recently was an individual that is 66 years old currently. And if he were to keep the pension plan through his employer, basically what they were offering him was $3,000 per month, every month for as long as he lives. This particular individual did have a spouse, so if he were to pass away, they had basically what was called a 50% survivor benefit, meaning that if he were to pass away, his spouse would then get $1,500 per month, every month for as long as she lived. But if both spouses were to pass away, then nothing was left over for heirs and beneficiaries. And he did have the option of taking a $560,000 lump sum and just investing that money someplace else on his own. So what we did is we took a look at the numbers, and what we found was there was an income annuity where he could roll the lump sum over, and then what he would generate per month would be right at $2,800 a month, every month for as long as he would live. Now, that's a little bit lower than what his employer was offering him, but there were a few added benefits. If he were to pass away, 100% of that income would pass on to his spouse. So rather than the spouse getting only $1,500 per month, she is now in a situation where if he were to pass away, she'll continue to get the $2,800 per month. And like I mentioned earlier, if they both pass away, rather than the heirs and beneficiaries getting nothing, there'll be a 100% death benefit paid out to the heirs and beneficiaries. So what that means is for as long as they live, each spouse would get $2,800 per month. If they were to both pass away, depending on how much money had been withdrawn, as much as $560,000 could go on to heirs and beneficiaries. This particular client decided that that was a little better deal. Even though the income was a couple $100 less per month initially, the income was going to stay the same for both spouses, and then if some sort of accident or something happened along the way, the employer doesn't get to keep all of the money. Their heirs and beneficiaries, in this case their grandchildren, will still inherit the majority of the money. So when we get this question, it really does depend. Sometimes you can roll it over and improve the circumstances a little bit. Sometimes the payouts are much higher with your employer and you just can't match or beat it anywhere else. So if you are retiring or have already retired and you're being offered a lump sum payout, give us a call at the office and or request an appointment through our website. We can get together and discuss it and give you some recommendations. There's a scenario that plays out in our office pretty often. We'll meet with a couple where either the husband or the wife, over all the time that they've been married, is kind of taking the lead with their investments or retirement planning. Sometimes couples will work on everything together, but it's not uncommon that one spouse wants to be involved and the other spouse wants to have little to no involvement. But as individuals start to get a little bit older, the spouse that isn't necessarily as well educated on the different options that are out there or hasn't been actively involved in the money management will want to take a more active role, or the spouse that's kind of always taking the lead will say, gosh, you know, if something were to happen to me, my spouse knows little to nothing about investments, we better do something. We want to start a relationship with someone that they could go to, or we want to already have an account established with someone that if something happens to me, then the spouse can go to and start working with them, and not a whole lot has to change with their retirement planning. A lot of times individuals will decide that it's maybe time to bring in a professional. Maybe they're tired of trying to do it on their own. And this could be either yourself or someone that you know. They want to retire, or they are retired now, and they want to do more traveling. So instead of watching what's happening in the stock market every single day, they want to be able to retire at leisure or travel without having to get up every single day, read the paper, check the brokerage accounts online, things of that nature. One option that we've been covering with a lot of individuals that find themselves in this situation where they don't necessarily want to just have a diversified portfolio of mutual funds. Maybe they've had a bad experience with a stockbroker in the past and they don't want to go down that route again. In our office, we talk a lot about what we call a managed money portfolio or a managed money platform. And one of the money managers that we work with is called Global Financial. And they have a great option for someone that's maybe just tired of investing money on their own, or they want to start a relationship with our firm, but they're not necessarily ready to turn all of their assets over to the firm all at once. They can start out by using Global Financial's conservative income portfolio. And I really like this particular portfolio because, again, most of our clients are retired or soon to be retired, and this portfolio is perfect for that. Now, this particular situation, there is a little bit of risk involved with it. Any type of investment that you might invest your money in is going to carry some sort of risk. But if we look at the track record of this particular portfolio, over the last 10 years, it has never had a down year. Even in 2008, it didn't make a lot, it made a little bit, but it's never had a negative year. So just as the name says, it's a very conservative option. Over the last 10 years, this conservative income portfolio has returned an average return of about 6%. And that's net of fees, because those that watch us here on the show know that we always warn against paying high unnecessary fees. Depending on how much money you have in your portfolio, the cost to invest money with Global Financial in this particular option is somewhere between 0.5% per year to as high as 1.5% per year. And that's all in. There's no additional costs over and above that. So for individuals that are getting a little tired of trying to manage money on their own, they're looking for professional money management, I think the Global Financial option is a good one. If you're not familiar with Global Financial, you can visit their website, but they're known as what's called an institutional investor, or sometimes what's referred to as kind of what the smart money is doing. That's what Global Financial can do for individuals that are looking for a safe place to grow their money at a reasonable return. And in this conservative option, like we said, over the last 10 years, it's averaged just at about 6% net of all fees. So if you're looking for some professional money management, maybe getting tired of doing things on your own, I think this is a good option to start out with. Maybe not all of your retirement portfolio, but maybe at least a portion to start to build and grow a relationship together. If you have questions about this particular option, again, you can visit the Global Financial website. You can call our office and or visit our website for more information.